The Central Bank of Nigeria's Monetary Policy Committee has decided to retain the country's benchmark interest rate at 14%. The CBN also decided to leave the existing cash reserve ratios for commercial banks at 22.5%. The later decision comes despite an advice from the country's finance minister, Kemi Adeosun, to lower interest rates so the government can borrow domestically to boost the Nigerian economy.
The direction through which you want to achieve it may differ for as long as you still achieve the growth. The issues here, just like we read in the communique, is that when you say reduce interest rates, there are two possibilities here. You are saying because you want that to spur credit to the private sector at lower rates. Or two, which I have heard the fiscal authority talk about, is that the fiscal authority needs to be able to borrow at lower rates to spend. Our own view at the MPC, because this was exhaustively discussed, and we said, well, in the past, there was a time when the MPC took a decision not only to reduce the policy rate, but indeed also reduce the cash reserve. These were intended to lower rates and encourage spending, particularly to the private sector. After we did that, the following meeting we also said, because we did not see the impact of credit to the private sector, that we needed to further reduce the CRR, because during that first session, when we reduced the CRR from 30.5 to 25%, it provided an opportunity for about 1 trillion naira that was injected by the CBN into the economy or made available to the banks. Rather than loan these monies to the banks, loan them to consumers, to agric manufacturing and SMEs, like we said at the communique, we found that those credits went to traders who used them in demanding for foreign exchange, which ended up putting pressure on the foreign exchange market. That was what happened. Subsequent to that, we said, fine, since this money wasn't deployed directly, that we were also reducing the CRR then from 25% to where it is right now, which is 22.5. That was going to provide close to about 350 to 500 billion naira through that avenue. But we said we were not going to allow the banks to really have the cash until they sent proposals to the Central Bank of Nigeria for primary agric projects, new manufacturing projects, and other kind of projects that will spur industrial capacity and manufacturing output. I must confess that the proposals we received were mainly for purposes of refinancing the liquidity of the banks. And we thought that was not what we wanted, and that's the reason we've been a little bit circumspect about releasing some of those liquidity. But we are looking at the books. There are indeed some very few of them that have submitted proposals for agric, that have submitted proposals for new manufacturing projects that we'll be considering in due course. Now, the second part of it was that, yes, if you lower the interest rate, what that would do is that makes it possible for the fiscal authorities to borrow at lower rates. We're saying, fine, if you borrow at lower rates to stimulate spending, what that does is that, well, yes, it stimulates demand for goods. But when you stimulate demand for goods by providing cash or money to be spent without taking action to boost industrial capacity, taking actions to boost manufacturing output, what happens is that you will see a situation where you have too much money chasing too few goods, which will also worsen the inflationary conditions that we are now. And that's why we're saying the option that we would like to adopt is, while the fiscal is going ahead to spend, right, what we want to do is to say at this meeting retain the rates where they are. When you say retain the rates where they are, you are still saying you want to maintain the fairly tight situation, so that will again, like we said at the last meeting, encourage inflow of capital. Because I must say it, truly I wasn't that optimistic initially, but today I'm saying that I'm looking optimistic, because between July and now, we've seen inflow of FX of above $1 billion. What were these used for? These were used to procure raw materials, or manufacturers bought the dollars to import raw materials. When you import raw materials, those manufacturers that said that they were closing would have the opportunity to now employ people. When you employ people, you increase your productivity, you produce your goods, the price of goods will be moderated from the monetary standpoint. Then you find the demand that you are spurring from the fiscal authority coming to match the demand, such that it does not result in an inflationary condition. That's what we're saying.